Hi, everyone. This is Rafael Terrazas, local El Paso real estate broker. I'm here with my good friend and fellow investor, Israel Franco. And the purpose of this uh, video is to kind of walk through what goes on in a monthly mortgage payment, break it down. And that way, when you're estimating your mortgage payment, you're not just looking at Zillow monthly payments estimate. You're actually able to determine a clearer view of what you're going to end up paying. So I'm going to walk you through it. I'm going to try and be as thorough as possible. The spreadsheet will be available via a link, either on our website or on the YouTube video. And feel free to comment any questions or send us an email with any other questions. We'll be, very helpful and try and answer everybody as much as we can. So I'm going to go ahead and get started. This scenario or this spreadsheet, it was created with multiple columns per se. That way you can compare your scenarios, whether you want to go with an FHA loan or a conventional loan or change down payments. That's why it was created. We can replicate it and include more scenarios, but we thought 4 was more than we could than would be needed. For this sample that I created, I'm going to go ahead and input the address. Anything in blue is something that you have to input manually. Anything in green is a drop-down menu, and anything in gray or white is just a calculation. So you don't necessarily have to modify those. There are some exceptions, which I will walk through. Anything in yellow has a note, which we highly recommend you read. It explains, it's short and it really does explain in a lot more detail what goes into this. There are only 4 sections with that. And again, on this video, we'll cover those specific details. Okay, so first thing I use on this sample is I put my address just so I can know what I'm comparing with. Because you could also compare homes, not just the same home with different scenarios. We're using an average price of $300,000 and an average interest rate of 4%. I know some of you out there will say that you've received an estimated interest rate of 2%, 2.5%, which is great. We're just using 4% for the purpose of this calculation. Now, if you have no idea what interest rate you're going to be paying, 4% is a good average to use, but I would check with your loan officer to see where you stand more or less. And then that way you have a more accurate figure.
Yep, and I think one of the beauties of the spreadsheet is you can put the same house with the different interest rate next to each other, and you can see the impact of your payment if you wanted to.
Exactly. That's actually a good point, because you can buy down interest rate, and if you do, you'll be able to see the payment difference per se. And we'll talk more about refinancing and different options in a later video. This one's just to show you what goes into a mortgage payment. Now, as far as terms and years, we're only giving the options of 15 versus 30-year note. So actually, that's a good scenario, Israel. Let's compare a 30-year note versus a 15-year note. The same house. We'll do 123 Main Street, same price, and same interest rate. If you look at the term months, 360 for 30 years, 180 for 15 years. Now, loan type. I do want to focus on this because a lot of people don't understand the difference between FHA and conventional loan. FHA is, it's an insured loan, and it's insured by the Federal Housing Administration. It is usually for first-time home buyers for the most part. And if you already have an FHA loan, usually your following loan will not be FHA, but it is an okay option for certain people. In my personal opinion as a broker, if you qualify for a conventional loan on the house, go conventional. There are some benefits that we're not going to go into in this video, but I will say usually conventional loans, you can get rid of your private mortgage insurance quicker than in an FHA loan, and easier. So rule of thumb, if you qualify for conventional, go conventional. If FHA, since it's more lenient, you only qualify for FHA, that's also a good option for you. Now let's just assume we're going to go conventional on this home loan. And if you look at this loan type, there's a description of, in the drop down, if you're going to put 10%, 15%, 25, 30% down payment, you can select it. You can select other, but you're going to have to manually insert the down payment. So let's just say 10% scenario, and let's just say 30% scenario. And then we can compare as well. We'll do the same thing here. We'll copy and paste, and we can compare those 4 scenarios. If you want to know more about FHA, I did add a note, and then I define a conventional loan mortgage, and there's a few more interesting details: conforming loan versus conventional loan, and then down payment. So I got all this information from Investopedia. It's quite easy to find, but this is a brief summary of what goes into it. So let's just assume we're comparing a conventional 5% down 30 years versus 15 years, and then different down payments. Let's just compare it on 30-year notes. Okay. This will give you your down payment. Key note, this is just the amount for the down payment which your note will be reduced by. There are other costs other than your down payment when you come to the closing table. Again, that's probably for another video, which we will be making a closing cost video. Look out for it, but definitely don't be fooled thinking that this is the only money you're going to have to come to the table with.
Yep. And that was one that caught me the first time I bought a house. Is I kind of had the down payment, but I didn't have enough for a lot of the closing costs, so we had to save up quickly to be able to cover all those costs.
Exactly. So you don't want to be caught off guard, and sometimes your realtor won't discuss this with you just because it's second nature to them, but it won't be second nature to you for the most part. Upfront PMI or private mortgage insurance, it's at 0 here because it's not an FHA loan. FHA loans will require an upfront PMI, which will increase your loan amount by a certain percentage. And that's another benefit of conventional loans. You don't have this. So again, rule of thumb, if you qualify conventional, go conventional. There are some other fees on an FHA loan, although it's usually easier to qualify based on debt to income and based on your credit score. In this scenario, we're only going to go conventional. Loan amount, you see the purchase price minus the down payment. And the reason I have a second line item for total loan amount is that if you were to go FHA, again, your total loan amount will increase, which will also increase your payment a little bit. That's why there's that second total loan amount line item. Okay, private mortgage insurance. A lot of people don't understand it. Briefly, it doesn't insure you, it insures the lender. And most lenders will require a private mortgage insurance if you do not put 20% down or more, because it's a riskier loan. The riskier the credit, the riskier the loan, the higher your PMI will be. Now, with that said, private mortgage insurance can be deleted if your equity increases in the property and if you request it from the lender for it to be removed. Once your equity, I think it's 20 to 22% equity, you'll be able to remove it. I was able to remove it on a rental property that I have, and it wasn't a ton, but it really helped. It just put more money in my pocket.
And that's an important question when you're shopping around banks for potential loans, is ask the question around, hey, what would it take to remove? Some of them will actually require a full refinance, which might have additional costs. Some of them, it's just more of proof that you have the equity and they can go through it.
Correct. So it does depend. Different lenders have different rules. Some lenders that do not sell their loans, which are very few, sometimes certain credit unions, they will not have PMI, but they usually do increase the interest rate because it's a loan that they're not going to sell. They're going to keep it for the length of the loan. So that's a little more information that you need to know. But rule of thumb, less than 20% down payment, they're going to require you PMI, unless it's an in-house loan or unless it's a private or hard money loan, which again, the interest rates will vary. So the way we calculated credit score here is we cut it by credit score. We divided the private mortgage insurance by credit score. This isn't going to be 100% accurate, but it will give you an idea. If you have a very good credit score, the annual fee is 0.25% of your loan. If you have good, it goes to half a percentage point. Average 0.85, which I'd probably go around that just to be safe and be more conservative. And if you have, really low credit, it'll really spike up the PMI. These are just rules. They're not exact. If your credit is low, that PMI may be a lot higher. And FHA loans do tend to have a little bit higher PMI.
So on an FHA loan, could you have the upfront mortgage insurance and the monthly? So it could have both on an
They
FHA?
will have both.
Okay.
An FHA loan will have both. It'll have the upfront, which increases your loan amount, and it'll have a monthly, which is usually higher than a conventional loan. Again, another reason why I would choose conventional if I qualify for it. For the purpose of this scenario, I'm going to go with the average credit score and calculate a 0.85% PMI. The annual PMI is about $2,400. Monthly payment is about $200. If you look at, and that actually might be a little bit high. Let's go with good. I'm hoping most of our viewers have good credit, so let's go with good. If you look at the difference here, it's $120. It lowers a little bit as your down payment increases. But then again, you gave 30% down and it lowered your PMI, only about $30. It'll probably be even lower than this because the bigger the, oh, actually, hold on. Actually, there's a mistake here. You know what? It shouldn't have listed a PMI here. Yeah, because it's 30. Oh, no, you know what? It'll, yeah, no, actually, it's fine. It'll clear it out here.
Okay.
Yeah, it doesn't calculate in the monthly, so it's fine. No big deal there. Okay, so anyway, for this, we're just going to leave it blank. Okay. I can't leave it blank because then it'll give me
We'll make these changes to the spreadsheet before loading it up.
Oh, okay. Okay. No, I know why it's there. It doesn't, I haven't filled out the next one. Anyway, so PMI, this one will not, 30% down will not have a PMI, and we'll compare them there. Next topic, which is a pretty long, lengthy topic, taxes. Okay, the best way to get an accurate amount on your mortgage payment, go to your county's central appraisal district website, input the address, and get the actual tax amount for the following year or for the current year. Once you have that information, let's just say for a house in El Paso, $300,000, let's just say it's $6,000. Let's just assume that's the amount. Input it here, and that's what it will calculate. If you're too lazy and just need a quick answer, you can also just select your city, El Paso, Texas. That's where we're based out of. And it'll generate it. So if you, let's just say you don't know your tax value, I just put El Paso and it'll take this estimate. Again, it's an estimate. I would rather be more specific. So if I were you, I'd go to the county website and input the specific tax amount.
And that's something we can do in a later video, is talk a little bit about taxes and homestead exemptions and all of that, which is a lot more detail.
We'll definitely talk more about that because a lot of my clients forget to claim the homestead exemption, and it's literally free money that you get by not paying as much taxes as if it were your secondary home. They're not, the central appraisal district is not going to do it automatically. One other thing to note, this city average, it's an effective tax rate. So El Paso's tax rate is probably closer to a little bit over 3%. The reason this effective average tax rate is lower is because the central appraisal district's value may be lower than what you're purchasing the property for. And as we mentioned right now, there are exceptions to this rule that will lower the effective property tax rate. So again, this is just for quick purposes. I highly recommend you get the actual amount and you input it here on the blue line. Either the average or the known amount will work for the purposes of this spreadsheet.
And okay, just to clarify, that city, like the effective tax rate is based on your purchase price, right? So it's based on the 300,000 above.
Correct.
Okay.
And usually a $300,000 home, especially in a market like this, will be valued lower than what you're purchasing it for. And when I say valued, I'm talking city or county value. Has nothing to do with, well, not nothing to do, but it has very little to do with market value. Okay, next line item, insurance average. This one's iffy just because it's so different. Somebody could be paying $100 a month, someone else can be paying $150, someone else can be paying $50. We only divide it into two sections, new home and resale. New homes do have a lower risk of a claim, so they are going to have a cheaper insurance rate. Resale homes will probably be higher. This is literally just a benchmark. Please don't go to your insurance agent and say you only should be paying 90 bucks a month. It is a good average, but again, it's not exact. It's an estimate.
And one of the fun things, or not fun, but one of the things you can work with your agent on is, let's say you already had car insurance and you're adding the house. Sometimes there might be a discount of doing it both together. So again, it's important to shop around. But that's one of the things that I was able to get some savings in the last house I purchased with Rafael.
Yes, sir, that's correct. Here we're assuming it's a resale home, average 90 bucks a month. I think I pay like 72 bucks a month on my home. Some people are going to pay 110, whatever, but this is just an average benchmark. We weren't able to be precise unless we have a specific property on hand. So the final chart here is, or table, I'm sorry, the final table here, it summarizes everything. The reason this is important is because a lot of times your Zestimate mortgage payment will only show you this section for the most part, which is, if you look at up top here in yellow, principal and interest only. This is what the Zestimate monthly payment will show you. If you live in El Paso, which is a very highly taxed county, your tax will be almost half of your mortgage payment. That's why it's quite important to get a precise figure on your actual tax amount. If you live in New Mexico, California, Colorado, those tax rates will be a lot lower. But those states also have state income tax, which is a whole nother story. Most people say it ends up balancing out at the end of the day. The only note the last thing I will say about state income tax is that it's not a deduction, and usually your property taxes you can deduct from your taxes when you're in your tax return. So anyway, if you look at this scenario, wait a minute, something's off. This is off. It's not showing. We're catching errors. Yeah, that's another error. It won't. First time here. Okay, perfect. This is a lot better. Let's compare the monthly payments. And I'm gonna hide these real quick just so we can see both items. Okay, check it out. From 30 years to 15 years, just the principal and interest goes up about 750 bucks,
yep,
more or less. So you're paying $750 more just on the note. The monthly PMI will be the same. That one, I'm not too sure, to be honest with you. I'm not sure if the PMI will lower on a 15-year note. It might, just because it's a lesser risk. But for the sake of this conversation, let's just assume it's the same. Your monthly tax is going to be the same. Whether you pay it off in 15 or 30 years, your tax is going to be the same, and so is your insurance. So the biggest variables will be your payment and potentially your PMI. So if you look at if we take the difference, if we subtract about 750 bucks difference in payment, which sure, it sounds like a lot of money, but at the same time, you're paying it in half the time. And we will talk about paying your mortgage off early or giving additional payments in a later video. That way you can analyze whether you want to pay off your mortgage sooner or not, how much it'll actually save you in terms of years and interest payments. Third scenario, we had put 10% down. What lowers your payment? Let's see how much your payment lowers by. Because remember, we're comparing, this is 30 years, so we're comparing it with this other 30 years. 72 bucks. So rule of thumb, for every, how much more are you giving? For every $15,000, more or less, your payment will be deducted by 75 bucks. So that's something important to think about, because some people want their mortgage to be really low, and they think by giving an additional 5, 10, 15% down payment, they're going to be able to have a much lower mortgage, which is not really the case. If you look at here, we gave $15,000 more, and it's only saving me $72 a month. So, think about how much down payment you really want to give. Your monthly PMI will most likely be lower than this with a 10% down payment. So you'll get a little bit of savings there. Again, taxes and insurance will be the same. So if we compare, again, the only difference here is it's $78. It'll probably be a little bit more, but it's not. You're not going to go out and buy a car with the savings with giving 10% more as a down payment. Now, last scenario, 30% down. That's a big chunk of change. It will affect the PMI. Why? Because PMI is at 0 currently. Same taxes, same insurance, and on your actual mortgage, from your original 5% down payment, you're going to be saving $358 plus the 119 on the PMI. So it's $477 a month. You're going to be saving from giving 5% down to giving 30% down.
Could we change that to 20 just to see just the impact of PMI alone and how much cash is going to be needed on the 20?
Sure. Let's do 20% here. $334. Okay, now let's just make a quick ROI, right? $334 times 12, that's how much you're going to be saving on a monthly basis. And then divided by, you're going to be giving, look, there's a lot, it's $60,000, I don't know a lot of people that want to put down $60,000, 20% down. But look at your, where's the percentage here? Sorry. Let's see. There we go. Okay, so 8.9%, return. I mean, it's a pretty good return if you think about it, but is that where you want to use the money? Or would you rather remodel your house or buy furniture or invest in the stock market? That's just something that, it's everybody's choice really. But fact of the matter is, here's the return on your investment if you were to put more of a down payment. It reduces your overall mortgage payment by $334 a month, which that could be a car payment really if you think about it. But you could also might be able to pay cash for that house with the difference in down payment. So it just kind of depends. It's more of a taste. We just wanted to walk you all through a sample scenario of how to come up with your own estimated mortgage payment. Your loan officer will be able to give you a more precise figure, but as we may know, they're not always available. And if you're trying to make a decision on a house relatively quick, this will be in a lot more detail, and you could do it yourself versus trying to get help from your realtor, which may or may not know how to do this, or your loan officer. Do you have any comments or questions, Israel?
Yeah, a few things. I think one of the things that we learned as we bought our first house years ago, and any house we buy, is the monthly tax amount, right? So you kind of get comfortable with that 2,100 or that 1,700 you're seeing, but that monthly tax amount is going to go up next year as things appraise. So don't think that this is going to be the payment you're going to have for the rest of your life. It's most likely going to go up in that tax, and maybe insurance goes down, and the note might stay the same unless you refinance.
Yeah, so that's a great point. Taxes do vary. You can fight them. We'll talk about that at some point too. That's a very important subject. Property taxes do tend to go up. It's very, very important that if you do one thing, if it's a house you're living in, claim your homestead exemption. In Texas, or in El Paso, I shall say, it saves you about $400 a year in taxes as your homestead, and it limits the increment of your property year over year to 10% of the value. So this actually happened to Israel. He had a homestead exemption, and the property value went up more than 10%. So he hasn't gone to the Central Appraisal District to fix it, but he will, and hopefully that they'll just limit the value of the home to a 10% increase versus what it increased overall. And we will be also later on talking about refinance. Everybody wants to refinance with a lower interest rate. That's great, but one thing to just keep in mind is that if you've already paid the house for 6-7 years and you have a 30-year note, you're only 23 years away. If you refinance to another 30 years, you're adding 7 years of payments. So it's not always, interest rate. Sometimes it might just be better to make an additional payment with the cost of that refinance and keep your mortgage shorter, or if you are going to refinance, consider refinancing to a 15-year note versus a 30-year note. But again, that's a subject for another video. We just wanted to establish how not to get confused with Zillow monthly Zestimate. And also, you can get as precise as you want with this spreadsheet, or you can get just a very high-level picture so that you can make a decision as to how much you want to offer on a property. This will be available for you to use. What we'll do, we'll share the link, click on the link, open the Google Sheet, and then make a copy of it. You won't be able to edit my sheet or our sheet, but you will be able to edit the copy you make. You can also download it to Excel, but there are some statements here that don't transfer properly to Excel. So if you're an Excel guru, all you have to do is find the ifs statements, and Excel will add an @ an ampersand. If you're not into Excel, don't even consider using Excel, just use the Google Sheets. But again, any questions, comments, feel free to leave a comment on this video or shoot us an email, and we promise we'll try and get back to you within 24 to 48 hours.
Yeah, and any other topic or any item that you feel might be good to deep dive on, we want to continue to do more of these podcasts and videos, not just around mortgages, but also around budgeting, personal finance, buy versus lease. So there's a long list of topics we have. We're both passionate about this, and happy to hear your feedback.
Thank you all for joining us.